we have our total debt here. Now here, when I'm talking about debt, we are talking about the debt already, the factual data, not the forecast data. Forecast is something we are assuming and forecasting. Here, whatever we are looking at is status as of today, that is as of historical 3. So debt will take from the balance sheet. I'll right click here and go to the balance sheet. Balance sheet. You had loan funds. You see total loan funds 1736 is the amount in your balance sheet under loan funds, row number 38 for historical 3. This is factual data. Okay, the most recent updated data. Anything in green zone that is forecast, that is something not fact, that is based on our assumptions, which we need to get it cross verified later. So 1736 is the total amount of debt that we have. All right, and let us just calculate our cost, the equity part as well. Equity will be, come back to our balance sheet here, shareholders equity. Yeah, and this is the equity section for shareholders. 1419.4, again factual data. What is the total capital, equity plus debt, total of equity plus debt? It is 3155.41. What is the proportion of equity of this total capital investment over here? Total capital, this is, capital is in the form of debt and equity, right? So here we got the total capital. Now what is the proportion contribution of equity over the total capital? We take a percentage, equity divided by total. We have that. You see on the left it is given equity divided by debt plus equity. Debt plus equity is this total. We say debt divided by the total. Okay, let me get this into percentage format and apply some decimals. So it's not exactly 45, but it is somewhere around 44.98. So we'll stick to single decimals. Yeah, this is easy. Okay, we'll use these values later once we get our cost of equity in hand. By the way, average debt. If you remember yesterday, we calculated average debt. Whatever debt ending balance you had in the current year and the previous year, you take the average of the two. So here we'll take average function. I go to the balance sheet. Here I have loan funds. So I take historical 3 and historical 2, the average of the two, historical 2 and 3. Okay, we take an average of total loan funds. So that is the average. Why do we always stick to average debt, and why not the opening part of the debt only or the closing part of the debt? No, we don't take that because I see here we are giving an approximate measure. So we don't take the opening balance or ending balance because throughout the year there could be some variance, right? What if you would have paid up your debt somewhere middle of the year, somewhere halfway throughout the year? Then calculating interest based on opening balance would incorrectly give you the interest for the entire year, wherein you would have just paid off your loan amount somewhere middle of the year. So that all that is quite a confusion, and especially when you're an outsider, you do not have any idea what is the exact interest being paid. So as a result, same way, how much of loan is due, you don't know, because some part of the short-term loans would be paid off and there will be a fresh due, a fresh loans borrowed. We don't have all that information. A safest bet will be taking an average because we are somewhere closer to reality. This is the closest that we have. Now, what is the interest expense for the year? Interest expense is given already there in our income statement. It is there in your debt schedule as well, but we can take it from income statement. No, it's not given in debt schedule. It's the historical information that we are looking at. Income statement, row number 18, in interest expense, 63.8. 63.8 in your income statement, interest expense. This is the interest expense. So what is the pre-tax cost of debt? Pre-tax cost of debt. Interest amount divided by average debt. So before you adjust for that tax, interest into 1 minus tax rate, first you need to determine what was the rate at which the interest was paid. Okay, now this is more like an average. Why? Because if you have taken short-term debt, let's say 3 months debt, then you would have paid interest for 3 months. If you would have taken a 1 month debt, then it's short-term borrowings, then you would have paid only for 1 month. So although your annual interest rate would have been, let's say, 12%, if you have borrowed for 1 month, then you would have only been you have only paid 1% interest. That is what it implies. We don't have interest expense, but we have financial expenses. Is it okay to use them? Financial expenses mostly comprise of interest expense. Generally, they comprise interest expense. Okay, mostly it's one and the same, but there are certain exceptions. Okay, for example, I'll tell you what. Here, what we are talking about is interest on debt. Okay, let's say you were under some legal battle with some other company over certain issues, and okay, and the other company had sued you for let's say $100 million. It was a so you lost the case, you lost the legal case. As a result, the court orders you to pay them $100 million along with interest of 2% or 3%. So you have $100 million that you need to pay, and the interest rate was 3%. Okay, now this legal battle was going on for closer to around 3 years, 2 years. Then what happens? You pay $100 million multiplied by 1 plus 3% for 2 years. Oh, my bad. It was supposed to be a plus. So you end up paying them 106.9. So you are paying what? 6.09 as the interest. Now, this is not the interest that you're paying on your debt, but you're paying on over and above. So whenever you see financial expenses, you need to also see if they are there, if there are any other exceptions to it. Like you need to dig into the notes, supporting notes for interest expenses in further disclosures of the company, and find out, does it include anything beyond. Generally, analysts, what they do is, some analysts, if 63.76 is the interest expense or your financial cost broadly, and this occupies, let's say, around $1 million or $0.5 million of interest towards your legal expense, then they do not exclude it. They also factorize it within this, because then it's a negligible amount. So some analysts, they might include this and treat the entire finance cost as interest expense. Some do that. And are they wrong? Well, conceptually, yes. But then, you know what? There is not much a major impact on the overall thing. What if it was, instead of 63.765, it was just 63.7? 63.7. Then, I mean, the actual interest paid towards bank, anything over and above would have been to someone else, legal or anything. So 3.29 was your pre-tax cost of debt. It is still 3.29. The only thing is, in terms of percentage, somewhere in 0.00 something changes would have happened. That's the only difference. Okay, the concept of materiality again comes into picture there. Okay, so before tax, this is the cost of debt that we are looking at.